This is to allow both smaller endowments, but also like family offices and just people with money to invest to enjoy the same investment strategy that a very long-term endowment.
Exactly.
Right. Okay.
Exactly.
So yeah, and I saw on your website you've almost branded it. It's the advanced endowment approach.
Yes.
I like it. Go on, tell me.
That's what we're trying to do. Okay. Yeah. Now let me start with the original. What are the key principles of the endowment model? Right. So I boil it down to three critical principles. Right. So the first one is no market timing. Okay. So what does this mean? It means stay invested through cycles. There isn't much to gain by trying to time these cycles. So everyone's got a certain level of risk appetite, right? So once you've got your risk appetite right, put the risk in place and stick to it, right? So that's sort of number one.
It's
right?
even more than that. It's like there's actually quite a lot to lose by trying to time.
There's a lot to lose. Yeah, absolutely. And so number one, no market timing. Number two, diversification, right? So diversify across asset classes and opportunities. And the reason you diversify is to create resilience, right? And so what does that mean? It means that, yes, you could just put money in equities and bonds, but actually, I think I was looking at the stat the other day, over the last 120 years, there's been 9 episodes where just equity bond portfolios have lost real returns over a 7-10 year period, right? So over extended periods of time, while at certain points in the cycle, it looks like simple portfolios, like just equity bond portfolios, could actually do just fine. There are plenty of occasions where actually that's insufficient to create a resilient long-term investment.
How frequent was that again?
It was 9 times in the last 120 years where they've lost real returns over at least a 7-year cycle.
And that's quite a lot.
Yeah.
Yeah.
So, I mean, it depends on which part of the cycle you cash, right? And so the concept of resilience is if you create more diversification, you're just able to cater to different types of economic environments.
What's the important types of diversification for you?
At the heart of it, what are you trying to do with diversification? You're trying to find different drivers of outperformance, right? So, or even just performance. So fake diversification is when you think you're diversified. Let's take hedge funds in 2007, before the global financial crisis. Hedge funds did extremely well in the 90s, right? Because they were sort of a nascent asset class, and you sort of came into 2000 and they were starting to ramp up assets. But by the time it was 06, 07, there were a lot of hedge funds, and a lot of them, if you looked at the old asset allocation models, you'd sort of usually have a line for hedge funds saying hedge funds, and there's sort of a low correlation to equities, bonds, etc. But the reality is that they actually were very correlated with the broad markets, right? Because what they actually held were sort of very broad market exposures, etc. And so that's fake diversification, right? Because you sort of look at it and you think, actually, I've diversified because I've got a different asset class. It's got a different asset class label.
Yeah.
It must be diversifying, but actually it's not, right? So true diversification comes when the actual underlying exposures you hold are driven, they have a different sort of axis of return, right? And so we think of it as, you have to embrace different types of risk premia. For example, when you take on credit risk, you're getting paid to take on default risk, and that's correlated but different to taking on equity risk, right? Where you're sort of betting on growth typically. So those are different parts, and you can see there's a lower correlation there. It's not a zero correlation, but there's a lower correlation. And so likewise, you invest in sort of fixed income instruments, you're taking on interest rate risk, so you get paid for taking on interest rate risk. So I think you have to go back to fundamental principles and make sure that the diversification is true diversification rather than fake diversification. Right. So back to the endowment model. So principle number 1, no timing. Principle number 2, true diversification. Principle number 3, invest with great asset managers. Right. So stitch together partnerships and put together a collection of great asset managers who are trying to generate outperformance in their asset classes, right, or in what they do.